Akshat, Shweta's having some trouble connecting. So, in the interest of time, I'll just take up the flow. May I request whoever is sharing the screen to please come to slide number 18? Yeah. In the meanwhile, just to give a brief introduction about myself, my name is Jayant Raghuram, and I'm an associate partner in the customs and advisory practice of Lakshmi Government Sridharan. I've been with the firm for more than 6 years now, and before that, I was working with the Ministry of Commerce. At LKS, my role involves advising clients on issues of customs classification, evaluation, interpretation of foreign trade policy, anti-dumping issues, etc. Thank you for inviting us for this webinar, and I'll be covering the customs portions of the budget 2024, which has been presented by the Honorable Finance Minister. Of the various changes, I'm just going to cover a very few changes which I think are most pertinent. Since otherwise also this particular budget does not make many substantial changes to from a customs perspective, apart from the some certain tariff changes. So just to summarize the kind of legislative changes that have been brought about, the first pertains to Section 28A of the Customs Act. And one of the changes is that so what happens is when you're importing good from a country with whom India has an FTA, the onus is on the importer to demonstrate the origin of the particular product. Earlier, the onus was limited to providing a certificate of origin to show that the product was originating from the particular FTA country. But now the parliament it has been proposed to expand the kind of proof that can be given to demonstrate origin. So the kind of proof that that is envisaged under the proposed amendment is that maybe even a self-declaration by a foreign manufacturer would also suffice, besides the usual uh, document of providing certificate of origin. But one implication is that this will require a higher degree of due diligence from exporters in case of self-declaration. The second legislative amendment proposed is concerning the mover scheme. As many of you may be aware, mover is a scheme where you may import goods in a warehouse and defer the payment of the customs duty otherwise leviable on the particular product till you manufacture the good and clear it from into the DTA or re-export it for or re-export it, in which case no duty is payable. The reason why, so what this amendment does is in section 65 is it permits the central government to notify those manufacturing activities which are not permitted under the mover scheme. The reason for this is because the recent decision of the Delhi High Court in Acme Hiragar, where it had struck down the CBIC's instruction prohibiting the use of the mover scheme for a generation of solar electricity, solar purposes. Earlier, Section 65 did not have this kind of legislative backing empowering the central government to issue these kind of notifications. But now this lacuna is proposed to be cured, and the central government may issue notifications restricting the kind of activities that manufacturing activities that are not permitted under MOVE. Yeah, next slide, please. With regard to the tariff changes, yes. Yeah, with regard to the tariff changes, most of the changes are, or rather, many changes are in the electronics and IT sector, and particularly there's been particular emphasis on the mobile phone sector. The BCD rates have been reduced from 20 to 15% for mobile phones, charges for mobile phones, and PCBAs for mobile phones. Also, one more incentive is that Chapter 40 goods, which are goods classified under Chapter 40 of the customs tariff, which are used for manufacturing of mobile goods, have also the effective rate has been reduced to 10% by way of amendment of custom notification 57 or 27. Apart from this, the budget also has provided exemptions from payment of BCDs in a number of instances. For example, import of parts for manufacture micro ATMs, fingerprints, reader scanners, and other such devices, parts for electronic toys, imports of lithium ion cells for manufacture battery or of a battery pack for mobile cellular mobiles, then certain goods for use in the manufacture LCD, LED, and TV panels, and exemptions from payment of BCD in case of capital goods or machinery required by the IT electronics industry, subject to the actual user condition. So these kind of changes show that the government is incentivizing or focusing on promoting domestic manufacturing by providing affordable access to inputs. A key feature of this year's budget is that the finance ministry intends to undertake a comprehensive review of all the conditional exemptions and notifications which are all provided. And some of the last date up to which these exemptions can be availed are they fall under various category, going so far as to 2020 March 2029, some to March 2026, and some of which end this year in September 24. And in some cases, exemptions are being removed altogether. So the implication is that for stakeholders, they will have to file representations seeking an extension where they think appropriate. Yeah, next, please. Then coming to my last slide, some of the other changes are that provide the budget provides extensions of time periods in certain cases. Now, where goods are imported goods are re-exported for repair purposes. Earlier, the time within which the re-import had to be done was 6 months. But now it has, in case of aircraft and vessels, if it's being imported for maintenance, repair, and overhauling. But now it has been increased from 6 months to 1 year, and this is further extended by 1 year, subject to the discretion of the jurisdictional customs officers. The related extension is with regard to duty-free re-import of goods. If they are exported out of India under warranty, the period in which it has to be reimported has been increased from 3 years to 5 years, which may further be extended by 2 years. So this makes the entire scheme a bit more friendly to importers and manufacturers in India. This is the implication. So that's it from my part, and maybe I can now hand over the floor to Shweta.
Thanks, Jen. Yeah, am I audible?
Yes, you are audible. And if you could on your video also, so it's more interactive.
I'm trying to turn up the video, but it says that the host is not allowed the same. You cannot start your video because the host has stopped it. That's what it says.
Okay, you just continue. I'll check.
Yeah, sure. So I'll just take you through the GST amendments. So there are majorly, say, 3 major amendments that have been introduced by virtue of this finance bill. These amendments have basically been in line with the council recommendations that were given under the 53rd GST Council meeting. And these are majorly in line with the idea of the government to have least amount of litigations. So the first important amendment that has been done is a new section has been introduced, which is section 74A. Section 74A is basically a culmination of 2 sections, which was earlier 73 and 74. So 73 dealt with cases where the show cause notice could have been issued in cases where there was no fraud. And 74 dealt with situations where the tax was not paid on account of fraudulent intention. Now 74A has done away with this distinction so far as the time limit for issuance of show cause notices is concerned. So earlier, in cases where there was a no fraud case, the time limit for issuance of show cause notice was effectively 2 years, 9 months, and then subsequent adjudication had to be done. This has now been increased to 42 months from the due date of filing of the annual return. So now, effectively, in case where there is a business is being carried out, the uncertainty increases in a situation that your case remains open, or there is a possibility of a tax demand being raised for a very longer period of time. This 42 months is a time period only for the purpose of issuance of show cause notice. Subsequently, the show cause notice has to be adjudicated within a period of 12 months. And this 12 months also can be extended by another 6 months. So effectively, if you would notice, it is 42 plus 12 plus 6. So it is 60 months within which, the entire proceedings have to be completed. Now, the benefit that has been extended, at least so far as, by insertion of this section 74A is that initially or originally, any tax that was paid post or under the section or under section 74, that was not available as a credit to the recipient. Now, that restriction has been done away with in section 17, which deals with the credit availment restriction. So, even if a tax has not been paid earlier on account of some fraudulent intentions, and that tax is subsequently paid post issuance of show cause notice, the credit of that will be available. So, this basically follows the age-old mechanism that the tax should flow along with the goods or the services, and the penalty, if any, has to be levied, then it has to be levied on the supplier. The distinction that has been carved out is on account of penalty that can be paid in a case where there is a fraud, or in a case where there is a bona fide mistake. So in case of fraud, the earlier time limits that were there, say 15%, 25%, 50%, or 100% penalty, those have been continued. Whereas in case of a bona fide mistake, the effective penalty would be nil. So if you have deposited the tax plus interest plus penalty before the show cause notice or within 60 days of the issuance of show cause notice, the entire penalty will get dropped if it is a bona fide mistake. So this seems to be like a welcome move. We can move to the next slide, please. The next important amendment that has been done is the famous amnesty scheme that the government keeps introducing from time and again. So this situation or this kind of amnesty scheme has been provided for the period 2017-18, 18-19, and 19-20. So it all talks about the fact that wherever there was a show cause notice that was issued under section 73 with respect to any tax pertaining to tax demands pertaining to these 3 years, then as a person who's liable to pay tax, I have an option to go to the government, say that the mistake has happened, I want to deposit this tax now, and then the government is going to give away the interest and penalty. Now, the date by which or the procedure, how the entire thing has to be paid, has not yet been notified. And in the GST Council meeting, they had at least given an indication that the amount has to be paid by 31st March 2025. So now, assuming for a moment, any tax was deposited during investigation or before the show cause notice, and the show cause notice was only issued for interest and demand, interest and penalty. All those cases where the demands pertain to the given 3 years, as an assessee, I have an option to go ahead and deposit this tax, deposit the tax if at all anything is payable, and then seek a waiver from the interest and penalty. However, a catch to this is that whenever one has to go and apply for this waiver scheme, if they had gone into appeal or if they had filed a writ petition challenging the order of demand, then that appeal or that writ petition has to be challenged. So the basic problem that is coming up is that in most of these cases, the tax demands were issued not on a single issue, but on multiple issues. So assuming for a moment, I want to deposit the tax or I want to take benefit of this scheme for one particular issue, whereas I don't want to take benefit of the scheme for the other issues, then how do we approach it? Something that is still lacking clarity in the proposed text. So for that, you'll have to wait and see if there is any clarity that will be given subsequently or by way of any circular or clarification. Another thing that is covered here is where your show cause notice originally was issued under section 74. However, on representation, the final order had adjudicated the demand to be under section 74. So those kind of cases will also get covered here. However, the procedure again is yet to be notified. Go to the next slide. One more. Let's go further. The third important amendment is section 11A. Now, section 11A is more of a legacy provision which used to be present under the erstwhile. However, under the GST regime, this kind of a provision was non-existent. So this provision basically allows the central government to issue notifications on the recommendation of the council in cases where there were non-payment of taxes by the entire industry. So effectively, say if there was a particular matter on which it was a general practice to either don't pay any tax or to pay a shorter amount of tax. Like a classical example could be a classification related dispute. You are assuming I was under the impression, as a supplier, I was under the impression that it would be chargeable to 18%, whereas the government or the correct classification would have been 28%. Assuming we are able to fulfill the requirement or satisfy the officers that it is an industry practice to charge 18% rate all throughout. In that case, we can ask for an 11A notification and ask for a waiver of the differential 10% tax for the past period. But once we kind of compare it with the erstwhile or the legacy provisions that existed earlier, is that if there was a person who had actually paid 28% tax in the past period, then whether there is a possibility to seek refund of the additional 10% tax that he has paid, that under the proposed section 11A is not there. However, it used to be specifically mentioned under the original or in the erstwhile regime, it used to be specifically mentioned. So again, this is something that we need to see that whether this refund mechanism is going to be introduced subsequently or not. There are various other changes that have been made under section 16 or under section 54 relating to exports. However, considering that we have shortage of time, I'll request my income tax colleagues to take up to explain the income tax related amendments.
Sure. Yeah, so I, along with my colleague Bharti, will be taking the direct tax and the income tax side of amendment that has been proposed in Finance Number 2 Bill of 2024. I Devshi Jain is presently a principal associate in the Lakshmi Kumaran, and I handle direct tax, international tax, and transfer pricing. And Bharti, my colleague, handles the tax litigation, tax advisory. She's a joint partner in LKS. Now, direct tax, if we see holistically, there are more than 99 amendments that have been brought in the direct tax side or in the Finance Number 2 Bill of 2024. We will be briefly touching upon some of the key amendments that have been made and which would be relevant for the present group. One important change that has been brought in is towards the capital gain tax structure. Now, capital gains going forward have been rationalized and simplified. That is to say, presently there were multiple taxation rates and multiple holding periods that was there for different class of securities and assets under the income tax regime for classifying as an asset to be a long-term or a short-term capital asset. Now, going forward, these time limits have been revised and different time limits have been subsumed into two categories. Now, going forward, there would be only two categories under the new proposed, as per the new proposed amendment, one of 12 months, which would be relevant for listed securities. So any listed securities held for more than 12 months would will be subject to long-term capital gains, while all other assets will be subject to the 24 months timeline. That is to say, any other assets such as gold, immovable property, etc., if held for more than 24 months, will be subject to long-term capital gain. Now, this way, they have tried to subsume multiple timelines that were there in the erstwhile law into a more streamlined or a structured manner. Now, this would be beneficial for some taxpayer, while it might not be for the others. Now, second major amendment that has been brought in is towards in the capital gain taxation rates. There have been an increase on a broader perspective. There have been an increase in capital gain taxation rates. When we look at short-term capital gain on listed securities which are subject to STT, we see that there have been an upward increase from 15% to 20%. So any listed shares which are held for less than 12 months have been sold will now be subject to a 20% capital gain tax. While for any other assets which are which are held for a short-term period, let's say an immovable property or otherwise, will be subject to normal taxation rate. There has been no change in the tax rate at that part. Similar as short-term capital gains on listed securities, even on the long-term capital gain part, long-term capital gains on listed securities which are subject to security transaction tax, that is to say any shares sold on NSE, BSE, etc., amongst other things. The rates therein also have been increased. Erstwhile, they were the transfer of these assets were subject to 10% capital gain with no indexation benefit. These rates have seen an around 25% upward increase, and now long-term capital gain on these securities will be subject to a 12.5% tax rate with no indexation benefit. Now, one of the major part is wherein the change have been brought in is towards other capital asset which are wherein long-term capital gain would be payable. Now, therein, although prima facie it seems that the government has reduced the tax rate from present 20% to 12.5%. However, they have one key amendment herein is that the erstwhile law provided that the 20% tax rate on long-term capital gain was subject to indexation benefit. Now, this indexation benefit has been taken away, although a reduced tax rate of 12.5% with no indexation benefit has been proposed. Now, this amendment would be beneficial for some taxpayer, while it might not be so beneficial for others. To put it in an example, if I, as a resident individual, is selling an immovable property or any other capital asset, wherein my return on investment is less than the inflation adjusted return, then I would be subject to an additional tax outgo which I would not have paid under the erstwhile laws. While there would be certain taxpayers such as startup entities, etc., which see phenomenal jump in a very short point of time. These startup entities or the shareholders of the startup entities who are taking an exit might be getting benefit from this reduction in tax rate, as there would be little to no indexation in those cases. Now, overall, when we see an upward trend in the capital gain taxation rates, which would be payable henceforth. That is one. Moving on to the next issue, angel tax. Angel tax has been a prominent issue for private limited company who have been issuing shares and been receiving money at a value in excess of fair market value. And this provision have been haunting the private limited companies on issuance of shares, as a provision which was brought in to curb the black money malice in 2012 was being used by tax authorities time and again as a measure to harass private limited companies on issuance of shares and to boost up the tax collection and meet revenue targets. Now, going forward, this provision have been amended, and a sunset clause has been put into place. That is to say, the provision would not be applicable for financial year 24-25. Resultantly, all issuance of shares by a private limited company, either at fair market value or otherwise, would not be subject to the rigors of Section 5627B. That being said, it would be interesting to see whether provision of Section 68, unexplained cash credits, and in addition which were addition under Section 68, which were being used as a tool by tax authorities to cater to such investment prior to introduction of 5627B, whether income tax authorities invoke this provision going forward after the provision of Section 5627B has been sunset. So all investments by private limited company may still need to be looked at from Section 68 perspective. Now, another category of changes that has been brought in is towards the TDS provisions, wherein a lot of TDS provision has been rationalized and new provisions have been introduced. Erstwhile provision has been streamlined, taxes have been reduced, and certain decriminalization towards the TDS provision have all changes towards that have also been made. Now, starting with a new provision that has been introduced, that is TDS on payments of partnership firm. So presently, there was no TDS that was to be deducted by a partnership firm while making payment to the partners. Going forward, a new provision have been introduced, that is Section 194T, pursuant to which any payment in excess of 20,000 rupees will now be subject to tax withholding of 10%, which is in the nature of salary, remuneration, commission, bonus, or interest, which is being made by a partnership firm to the partner. Now, this provision would be applicable prospectively from 1st April 2025. But yes, partnership firm going forward, making payment to partner needs to have a careful look at it and ensure that proper TDS is being deducted. Forward, a provision, a very common provision that is there, and the very common litigation that was going on, that is the interplay between TDS under 194J and 194C. So 194C, as it stands now, provides that tax needs to be deducted on payment being made to resident contractor for carrying out any work. Similarly, 194J provides for TDS on payments being made to professionals or for payments being made for technical services. Now, earlier there used to be a dispute with respect to 194J and 194C as to under which section TDS needs to be deducted. In order to streamline the provision, earlier finance bills and finance acts, the government streamlined the provision to say that technical service and TDS on technical service and TDS on work needs to be deducted at 2%. However, even after making this change, there was still ambiguity in the provision, as there were certain works which would qualify as professional services, which was subject to a higher TDS rate of 10% under 194J, thereby a mismatch in the provision. So, an example of that could be wherein an advertisement service is being provided by a professional. Now, considering advertisement as a service is included both under 194C and 194J, wherein professionals are involved. Now, the dispute was still present. Now, in order to cater to this sort of an issue, and a specific amendment has been brought in under the definition of work under 194C to provide that if a service qualify as a service under 194J and 194C, then TDS needs to be deducted under 194J itself, that is at a higher rate or otherwise. Now, with this, the existing litigation that surrounding TDS provisions under 194C and 194J should definitely reduce. So this is definitely a positive change. Apart from that, there have been certain provisions, TDS provision, wherein the tax rates have been reduced. And without going too much into detail about all these provisions, I will specifically, considering the audience, I will specifically jump on to a specific amendment that has been made under 194O, wherein the TDS rates have been reduced from 1% to 0.1%. In case wherein payments were made by e-commerce operator to e-commerce participant. So presently, the provision provides that any payment made by e-commerce operator to e-commerce participant will be subject to a TDS rate of 1%. However, in case of an offline sale of goods, wherein payment is being made for purchase therein, the TDS was 0.1%. In order to make consistent the provision, the consistent, that is TDS deducted on offline sale of goods and TDS deducted on online sale of goods, the TDS rate under 194O have been reduced from 1% to 0.1%, and this would definitely be a positive change going forward. Now, apart from the reduction in TDS rate, certain other amendments have also been brought in the TDS provision, where one such amendment is prescribing a time limit for filing a correction statement. Presently, TDS and TCS correction statements does not prescribe, the provision does not prescribe a specific timeline by which a taxpayer needs to file these correction statement in case there is an error in TDS and TCS statements. Now, going forward, this lacuna has been abridged, and a specific amendment has been made to provide that TDS and TCS correction statement needs to be filed within 6 years from the end of the financial year, wherein the original TDS or TCS return was furnished. So a 6-limit outer time limit has been prescribed for filing TDS and TCS correction statement. Now, moving on to the last amendment, second last amendment that has been made in TDS that we'll be covering in this section is towards decriminalization of delay in payment of TDS. Now, in line with the government's objective of to promote ease of doing business and to decriminalize the taxing statute, the government has made amendment under 276B, wherein an amendment has been made in section 276B, which provides for punishment or rigorous imprisonment for the term of 3 to 7 years in case there is a non-payment or delay in payment of TDS. The present provision provides that tax deducted needs to be deposited with the exchequer, that is government, on a monthly basis. However, any failure to do so, the income tax officer is empowered to impose prosecution and initiate prosecution-related proceeding. Now, in order to decriminalize this provision, an amendment has been made in wherein the amendment provides that in case the tax deducted is deposited with the central government within the timeline for filing the quarterly TDS statement, then although interest etc. provision and interest liability would still be there, however, there would be no prosecution in such cases. That is to say, if they are broadly giving a sort of a 3-month period to the taxpayers who have deducted TDS to deposit it with the government while decriminalizing the same at the same time. However, it would be interesting, the provision right now, as they are worded, it is not clear as to whether this timeline should be see qua the original TDS statements or qua the TDS correction statements. So that is something that we will have to evaluate in detail, and taxpayers needs to be cautious in this regard. Lastly, there is a timeline time limitation has been prescribed for deeming a person as SSC in default. So presently, any person who have not deducted TDS or TCS, or if they have deducted TDS or TCS but have failed to deposit it with the central government within the within the timeline, then such person can be deemed as SSC in default. Now, in case of TDS, wherein payee is a resident, there is an outer limit of 7 years for prescribing or for deeming a person as SSC in default. However, there is no such time limit that has been prescribed in case where the payee is a non-resident. Now, in order to streamline the provision and to ease the stringency in this, the provision has been amended, has been proposed to be amended to provide that a taxpayer will not be deemed to be an SSE in default for failure to deduct or collect tax after 6 years from the financial year in which payment is made or credited, or the tax is collectible, or 2 years from the end of the financial year in which the correction statement is delivered, whichever is later. So it is either 6 years from the payment or credit of tax, or 2 years from the date when the correction statement is filed. So thereby they are basically reducing the timeline for a taxpayer to be deemed as an SSE in default. Now, with this, I would ask Bharti to take up the balance amendments that have been brought in the income tax provisions.
Thank you very much, Devashis. A very good evening to one and all present here. So I will take about 10 minutes to briefly explain some other crucial amendments that has been proposed in the present budget. An important introduction that has been made in the present budget is introduction of a Vivad Se Vishwas scheme, which is introduced in the finance bill itself. Now, we all know that in 2020, the government had introduced a similar scheme, which basically permitted SSEs to settle the disputes that were pending before different appellate forums. Now, these disputes at that point in time included both appeals that were filed by the SSE as also appeals that were referred by the department. A similar scheme has now been proposed in the present budget, Vivad Se Vishwas 2024. Now, this particular scheme will cover all pending appeals or writ petitions that are pending as on 22nd July 2024, which is the specified date under the scheme. A last date will be notified at some point in time in future, and within that last date, the SSEs who are choosing to opt to settle under this particular scheme will have to file a declaration. Now, the salient features are that if somebody opts for this scheme and files a declaration, then he or she is required to pay a particular sum. That is, if it is an appeal which is pending on or before 31st Jan 2020. Now, why is this 31st Jan 2020? Because that was a specified date under the 2020 VSV scheme. So, if somebody had an appeal pending as on that date, but for some reason did not choose to opt for the VSV 2020, then that person can also opt for VSV 2024, in which case he will be required to pay the entire tax which is disputed plus 10% of the disputed tax. So essentially, he has to pay 110% of the tax that is disputed. If he pays that, then the interest and penalty will be waived off. If, however, that is an appeal which is filed after 31st Jan 2020, then that person will have to pay 100% of the disputed tax. Now, this 100% and 110% which we just spoke about will apply provided the payment is made before 31st December 2024. But if payment is made after 31st December 2024, then there will be an additional 10%. So this 100 becomes 110, 110 becomes 120. Now, similar settlement scheme is also available where the appeal solely relates to an interest or penalty. For example, it could be a 201 interest issue, or it could be a penalty under some section. Then that interest and penalty can also be settled. Similar to what we spoke a while earlier, if the appeal is pending as on 31st Jan 2020, then he will have to pay 30%. If it is after 31st Jan, then he will have to pay 25%. All this is subject to the payment being made by 31st December 2024. If the payment is going to be made after 31st December, then an additional 5% has to be paid. If the appeal is an appeal which the department has filed, or if the appeal is an appeal that the SSE has filed, however, in the SSE's own case, there is a decision by a higher forum, be it the ITAT or the High Court, and it is not reversed by the High Court if it's an ITAT decision, or the Supreme Court if it's a High Court decision. Then in that case also, notwithstanding that it is an SSE's appeal, the amount that the SSE will be required to pay to settle a dispute under this scheme is only 50% of what is otherwise payable. Now, this is very important because it will be important for people to revisit whatever appeals are pending, ascertain the viability of or otherwise of success in that appeal, and if it is felt that it may be better to settle this dispute, then it will be better to opt for the scheme, because what is got under the scheme is complete waiver of interest and penalty. Yes. However, this is not a blanket scheme that is available to everybody. There are some exclusions that are given. If the assessment is consequent to a search, or if the case also involves prosecution, or if it involves income which is undisclosed from a source outside India, or if the assessment has been consequent to any information that is received from some other country, or it is in relation to a matter where the detention order or prosecution has been instituted under some other act like narcotics or PMLA, then all these cases, that SSE will not be eligible for the particular scheme. Yes, next slide, please. Now, two prominent differences between the earlier VSV and the present VSV, 2020 and 2024, is that in the earlier scheme, in the present scheme, if the assessment is consequent to a search, then VSV 2024 cannot be opted at all. However, in the earlier scheme, it could have been opted provided the disputed tax did not exceed 5 crores. Now, in the VSV 2024, it is very important that something should be pending as on 22nd July 2024. That is, an appeal should have been filed, a writ petition should have been preferred, an objection should have been filed before the DRP. That should be pending as on 22nd July 2024. However, under the 2020 scheme, it was more broad in the sense that even if appeal was not filed, but if the time limit to file an appeal has not expired as on that specified date, which was 31st January 2020 under the earlier scheme, even in that case, a person could have opted for VSV 2020. However, that benefit is not available at present. Now, in the VSV 2020, there were certain clarifications that were issued to clarify certain queries that arose consequent to the scheme being put in place. One may expect similar clarifications to be issued. If that is not issued, then the question arises as to whether, since the two acts are going to be pari materia, whether those clarifications can be applied to the present scheme as well. Now, whether non-residents can avail FTC, if they opt for the scheme, then that remains a question mark, because under the VSV scheme, there's a specific provision which says that once you file a declaration, you undertake that you will not pursue any benefit or any other benefit or remedy that you may be getting under this law or any other law. So whether FTC is going to be available for the non-resident, that remains a question to be answered. Yes. This is another significant announcement that was made by the Honorable Finance Minister in the budget. The monetary limits for filing appeals by the department has been enhanced. The formal circular in this regard is yet to be issued. What was earlier 50 lakhs, 1 crore and 2 crore being monetary limits for appeals before the ITAT, High Court and Supreme Court respectively, has now been proposed to be increased to 60 lakhs, 2 crore and 5 crore respectively. So once the circular is out, we will have complete clarity on what all it covers, whether it covers pending appeals or appeals yet to be filed. All those will be known. Yes, next slide, please. Now, an amendment has been made in section 47. Now, as we all know, tax of capital gains, the charging section is section 45. The trigger point for taxing is that there has to be a transfer. Now, section 47 provides exclusion where certain transactions are considered as not transfers. Now, in that regard, in clause 3 of section 47, any transfer under a gift, will, or an irrevocable trust was excluded from the ambit of transfer. Now, since the exclusion was broadly worded, even gifts that were made by one company to another was considered as not transfer and consequently were not subject to any tax implications. And this was used by corporates to get tax advantage in certain transactions. Now, this particular provision has now been proposed to be amended, wherein the exclusion from the ambit of transfer will apply only if it is made by an individual or HUL. That is, gift by a corporate will no longer fall within the ambit of section 47 and therefore will not enjoy the benefit of non-taxability. We can proceed to the next slide. Yes. Now, as we all know, in Finance Act 2021, the scheme of reassessment was completely amended and rationalized. A new section 148, new section 148A, 149 time limits were altered. And the scheme that stood earlier was completely revamped. Now, this present finance bill seeks to bring out certain further amendments and rationalization to the scheme that has been put in place by Finance Act 2021. In sum and substance, the crucial things that are to be noted is, one, the outer limit for carrying out reassessment has now been reduced to 5 years and 3 months from what was earlier 10 years, which means that now a notice under 148 can be issued up to a maximum period of 5 years and 3 months from the end of the assessment year. Earlier, this period was 10 years. Earlier, there was no specific time limit for issuing notice under 148A. Now, what is 148A? 148A is a pre-SCN procedure. Before issuance of 148, an assessing officer has to issue a notice under 148A and ask the SSC as to why the assessment cannot be done. In light of the information that is in his possession, the SSC is given an opportunity to respond, and then an order is passed deciding whether it is a fit case to take up the case for reassessment. There was no time limit for issuing a notice under 148A earlier. Now there is a time limit that is put in place. The outer time limit here is 5 years from the end of the assessment year. This outer time limit applies where the income that is likely to have escaped assessment is 50 lakhs or more. Otherwise, the time limit is 3 years from the end of the assessment year. Now, before the present provisions, that is unamended provisions, they provided a time limit for passing the order under 148A. Now, all those time limits have proposed to be removed in the present finance bill. Now, these provisions will come into effect from 1st September 2024. Transition provisions have also been put in place to say that if there is a 148 notice or a 148A order which has been passed before 1st September, then those cases will be covered under the old scheme. However, a question that remains to be answered is what happens when the 148A notice is issued before 1st September, whether that notice can be said to be invalid or whether the proceedings will continue under the amended under the amended scheme is something that one has to watch out and answer. Another point on this reassessment is that earlier search proceedings were part of the reassessment. Now search is excluded from the scope of reassessment and a new scheme for assessing search cases has been introduced, which we colloquially refer to as the block assessment scheme. We can proceed. This is yet another small amendment. I will just quickly mention this. There's an amendment in section 28 regarding business income, where it has been specified that if there is an income from letting out of residential house, then that income will be taxable only as income from house property and not as business income. What is residential house is not defined, and therefore there are going to be some disputes around what will qualify as residential house and what will not. We can proceed. Buyback of shares. Due to paucity of time, I will only briefly touch upon this particular topic. Now, the tax on buyback of shares was levied in the hands of the company, similar to what we had for dividend distribution tax. Now, this particular provision is supposed to be removed from 1st October 2024. And going forward, the buyback income will now be taxed in the hands of the shareholder as deemed dividend. There will not be any deduction that is allowed against that income. And a question arises as to what happens to the amount that the shareholder paid when he acquires a share. There's a question on whether it will be allowed as a loss or whether that expense will entirely not be allowed at all. That's a question that is pending to be answered. Yes, we can proceed. Now, individual income tax rates, certain realignment to the tax slabs under the new scheme is proposed to be made. In effect, that results in a tax saving of about 10,000 if somebody is in the 30% bracket. Similarly, for salaried employees, the standard deduction, if he is going to pay tax under the new regime, is proposed to be increased to 75,000. And 80 CCD deduction for employer contribution is proposed to be increased from the present 10% to 14%. So this is in brief of crucial amendments that have been made under the income tax. I now request my colleague from the corporate team, Mr. Pratyush, to please take over the amendments under the corporate law.
Yeah, thanks, Bharti. Yeah, good evening, everyone. Myself, Pratyush Jain. I'm part of the corporate and regulatory practice at LKS. To briefly touch upon the reforms other than taxation part, the theme of the budget also focused on employment, skilling, and certain benefits that are required to be provided to the MSMEs. Focusing on these three schemes, Scheme A is the first-timer scheme. It says that the scheme will be available to all business sectors, and the eligible employees would be those who have previously not registered with the EPFO, which means any fresh employee who will be joining the workforce and is not registered with the EPFO will be entitled to a benefit. Now, the government has proposed a direct benefit of 15,000 rupees that will be required to be paid to the employees directly. Now, it's interesting that the scheme mentions that if the employee leaves the employment within a period of 1 year itself, the onus of refunding this benefit will lie on the employer. Another scheme is Scheme B, with respect to the increase of the workforce in the manufacturing sector. Now, with respect to the upskilling of the workers and to boost the manufacturing sector, the government has proposed that certain EPFO contributions will be provided as an incentive to both the employer and employee in equal proportions. The eligibility condition says that the employers should have a track record with the EPFO for a period of 3 years. Then only the employer could be eligible to take benefit under the scheme. Another condition is that the employers are required to hire at least 50 new workers or increase in the baseline of the workers by 25% of the previous year's registered EPFO employees. Now, Scheme A and Scheme B both intends to cover only those fresh employees who have not taken up employment and have never been registered with the EPFO. Scheme C is a general scheme which is available to existing EPFO employees as well. It provides an incentive of 3,000 rupees to the employer towards the contribution of the EPFO. Now, in order to be eligible under this scheme, organizations having employees less than 50 are required to hire at least 2 new employees, for which they'll get the incentive of 3,000 rupees per month towards the EPFO contribution. And for organizations having more than 50 employees, they are required to hire 5 or more employees in order to avail the benefits. It is also proposed that the existing Shram Suvidha and Samadhan portal, which facilitates the labor compliance requirements with respect to filing of the monthly returns, quarterly returns, and other aspects, would be simplified, and it would be integrated with other business portals run by the government. There's also mention of an internship opportunity scheme in which 1 crore youth will be provided internship opportunity with a monthly stipend of 5,000 rupees by the top 500 companies. It's interesting here to note that participation of companies has been kept voluntary. So whether companies will be willing to take such huge number of interns will be required to be seen. Next slide, please. Thanks. Now, other major changes that also been highlighted in the budget are with respect to the insolvency resolution cases. The government is proposing to set up an integrated tech platform which will provide transparency and other details with respect to pending insolvency cases to all the stakeholders involved. The government has also proposed that new additional tribunals will be set up in order to reduce the burden on the existing tribunals with respect to the pending cases. There's also mentioned that certain tribunals will only deal with cases involving Companies Act, and yet another set of the tribunals will deal only with cases with respect to insolvency. Now, similar to the CPACE mechanism that was introduced in the year 2023 for voluntary closure of the companies, the benefits of such closure mechanism and easy winding up of the businesses has been extended to LLPs also. In line with the Jan Vishwas Bill 1.0, which provided certain relaxations with respect to decriminalization of offenses to the companies, the finance minister also mentioned in the budget that the government is working on a Jan Vishwas Bill 2.0. And the industry will soon see certain other offenses also getting decriminalized under the existing laws. There's another update with respect to food sector and space sector as well, which I'm not touching due to paucity of time. Next slide, please. With respect to the MSMEs, the government has provided certain additional benefits. The government has mentioned that a finance support will be provided to the MSMEs who intend to buy machinery and equipment without the requirement of providing any collateral or a third-party guarantee. Now, the government also intends to provide financial support to the MSMEs who wants to transition to cleaner form of energy for conducting their businesses. At present, the public sector banks use the asset or turnover criteria to determine the credit worthiness of the MSMEs in order to provide them or grant any financial assistance. Now, it is proposed that a new in-house assessment will be developed by which the public sector banks will check on the digital footprints of the MSMEs and then determine the credit worthiness of the MSMEs. This would mean that MSMEs will be required to comply with all filing compliances, including GST filings and other aspects, such that it could create a trail on which the banks can rely upon that this MSME is law compliant and law abiding. Accordingly, it would be better to grant loan to them. The turnover threshold for buyers also on the TREDS platform, which is the bill discounting platform for the MSMEs, has been reduced to 500 crores to 250 crores. Yeah, that's all from the corporate side. If the attendees have any question, the relevant teams will be happy to take it up.
Thank you very much for your detailed presentation, and due to paucity of time, we are just skip the Q&A session, but I request to all my participants and the viewers, please send your queries to me over the email or the WhatsApp on my number so that I can share that all the queries with our experts and answer all the queries in our next session. And thank you very much to all my panelists for their sharing their expertise with us. And I only have one one remark from your side, that how much give you out of 10 to this budget on the side of the MSME and startups, and on the side of the individuals and the large corporates. Hello? Hello? Am I audible?
Aarti ma'am, would you like to take it up?
I think it's better that we don't, it's all policy decisions. in all fairness, it would not be appropriate to give out any score or anything of that sort. So let's just leave it discussing and analyzing the pros and cons of each decision that has been made.
Great. Okay. So now we are ending this session and see you on our next session, which is on 29th of July on Monday on same time 3 to 4 with the Ministry of Electronic and Information Technology. And the theme of the session is the entity DG locker. We know about in detail about the entity DG locker and how it's beneficial for MSMEs and the startups. So stay tuned with us on social media and